Welcome to the HDIN Research 2026 Strategic Performance Review. Today, we examine HD Hyundai Group's ongoing transition from a traditional asset-heavy manufacturer to a high-tech platform centered on green energy and AI integration. This session covers the fiscal year 2025 performance and the strategic roadmap for 2026. We begin with the current market context. As of late 2025, the heavy industry is entering a structural supercycle. HD Hyundai has successfully leveraged its dominance in maritime and energy to deliver a 9.3% operating margin in Q3. The core takeaway is the group's pivot toward higher valuation multiples by focusing on tech-driven integrated platforms. However, this growth is not without challenges. We observe a, quote, triple threat of complications: escalating U.S. trade protectionism, geopolitical volatility affecting crude spreads, and persistent labor shortages. These factors necessitate a strategic departure from volume-based competition toward higher margin resilience. This brings us to our core inquiry. In an era of geopolitical fragmentation, how can HD Hyundai sustain quality growth? We will now analyze how technology leadership serves as the primary tool for margin protection. To answer this, we look at the DuPont analysis for Q3 2025. The data shows that ROE improvement is being driven by net profit margin expansion, specifically 5.4%, rather than financial leverage. This indicates a healthier, quality-driven growth profile as the group optimizes its asset turnover. Looking at the consolidated figures, revenue reached 18.2 trillion Korean won in Q3, a nearly 10% year-on-year increase. More significantly, operating profit surged by nearly 295%, with the net debt ratio falling sharply to 9.3%, providing the group with a robust balance sheet for 2026 investments. The shipbuilding division, KSOE, is currently prioritizing value over volume. With a record 105.5% capacity utilization, the focus is on a high-price backlog of LNG and ammonia carriers. This strategy resulted in a 13.9% operating margin, a significant benchmark for the industry. HD Hyundai Electric remains the star performer. It achieved a record-breaking 24.8% operating margin, fueled by the global AI data center boom and North American grid modernization. The current backlog provides visibility through 2028. In construction equipment, Site Solutions demonstrated resilience despite a cyclical downturn. By shifting focus toward North American and emerging markets to offset weakness in China, the segment maintained a 7% margin and accelerated its Site Cloud digital automation platform. Our analysis of emerging segments shows high potential. HD Marine Solution is enjoying an 18.2% margin by shifting to recurring data subscription models. While the robotics division remains in an investment phase with current losses, its AI welding solutions are critical for future shipyard productivity. Regarding geopolitical risks, HDIN Research observes a proactive defense strategy. By localizing capacity in the U.S. and leveraging maritime trade frictions to capture market share from competitors, the group is successfully converting external threats into expansion opportunities. The digital pivot is centered on the OceanWise ecosystem. This is no longer just about building ships, but about providing the software, such as Avicus for autonomous navigation, that reduces client OpEx and builds a long-term data moat. On the environmental front, the GX roadmap is diversifying. Beyond LNG, the group is investing in the hydrogen economy and SMR research. The integration of plastic-to-oil technology at Oilbank further aligns the group with circular economy principles. HD Hyundai's ESG maturity is reflected in its 70% dividend payout commitment for the next 3 years. This governance strength is designed to signal confidence in free cash flow and support stock price re-rating. We must note critical risks. Sensitivity to thick steel plate and copper prices remains high. The group is mitigating these through long-term contracts and commodity hedging, while addressing labor shortages through aggressive shipyard automation. A competitive look at the electric equipment sector shows HD Hyundai Electric significantly outperforming global peers like Siemens and GE Vernova in terms of margin. This is attributed to its highly specialized focus on high-voltage infrastructure. Within the Korean Big Three, HDKSOE maintains the lead in profitability. Its internal sourcing of engines and electrical components provides a cost advantage that Hanwha and Samsung are currently striving to match. The 2026 roadmap is clear. H1 will focus on the commercial launch of Autonomous Navigator 2.0, while H2 will see the expansion of U.S. transformer capacity. Long-term, the group is positioned for 100% green shipyard operations. In conclusion, HDIN Research views HD Hyundai as a structural re-rating story. The group has successfully decoupled from raw material cycles. 2026 is expected to be the year where service-based software revenue begins to fundamentally augment manufacturing margins. Thank you for your attention. We are now open for questions. For deep dive research or customized strategic reports, please contact our team at HDIN Research via sales@hdinresearch.com.